Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon, all. Apologies for that little confusion when I started up the spaces from yesterday that I shared out there. My audio, it wasn't giving me any audio, so not really sure what happened, but I see a few of you guys have trickled in. So we will get going here in just a second. Let some folks, perhaps some other folks join. So just give me 1 minute. All right, let's rock and roll. It's a small group, but no worries. So 12:05 on Thursday, May 23rd. A lot going on. Keith and Ryan Ritchie did a great job on the macro show this morning, kind of running through today's setup. But obviously here to answer any questions and to provide some additional color and certainly things that I think are popping off the page and are worthwhile from a signal from a signal standpoint as we go into next week, which is actually going to be the last week of the month of May, and as we head into the month of June, the last month of the quarter, and then the next quarter and the back half of the year. So lots to cover. I think there's some important things to be commenting on, and as I mentioned, or as the kind of title of both yesterday or the original one and today, I think volatility, certainly US equity volatility is should be kind of top of mind for everybody as yesterday unfolded. The folks are putting a big premium and we're certainly hedging their books on a very short dated basis going into the NVIDIA print. Keith talked about that on the macro show this morning, even on the call. But again, it's very worthwhile to review. We've been seeing this happen a number of times across various events, whether it be earnings like Apple, Microsoft, et cetera, Google, or even macroeconomic events like FOMC meetings and CPI prints and that kind of thing. So I think the big thing here is, and if you can be shorter term and a bit more tactical, then you can take advantage of that, right? You can either do it through options or just do it through underlying positions, but kind of taking advantage of sort of the episodic and non-trending things that were happening within the volatility space in general, certainly yesterday. And now, we saw, VIX 1 day that closed up near 16 yesterday and just north of 16. I think it was 16.23. And today it opened at just under 8.5 and is trading at the moment at 8.63. So again, VIX 1 day is just one very common measure that you can leverage. It's certainly not perfect for the CBOE, but I would definitely highly recommend that you have both the VIX 1 day, VIX 9 day, and then the 30 day and 3 month. Really, I mean, it goes across the CBOE, gives you across the gamut. So you should really be paying attention to how those things look, both on the shorter duration and the longer duration. But certainly in this environment, the shorter duration has a pretty big impact in terms of just flows and dealer repositioning, et cetera, on a daily basis. So just really wanted to call that out. I think, again, just from a volatility standpoint, you're seeing it in the MOVE index, right, down sub 82.5, which is its lowest level since, I believe, 2019. You're seeing it in the high yield market, which is high yield OAS spreads. That's down at 3, which is down about 7% on a month-over-month basis. VIX, our VX, trading down in the teens. So it's lost its 20 handle. The VIX is down sub 16 at 15, just under 15.5. And then, as I mentioned, the VIX is sub 12 here. So you're really seeing it across the board, including both gold vol a little bit higher at kind of 16.5. Where is it today? That's where it closed yesterday. Yeah, so around 16. Gold, I think, is interesting. I'll get into that. So it could be a good pivot here into kind of the the precious metals and commodity space. Gold looks a lot looks different than crude oil, certainly at the moment, right? Where the top end of the risk range, which is up at 2,453, although it's a lower high and a lower low for GC for gold, it is still indicating a higher high on both across all durations actually at the moment. So 10-day, 15-day, 21-day, 63-day basis. So really on both the trade and trend duration, you're implying basically new highs, which is a good thing. And if you get portfolio solutions, and you can see what Keith did in terms of adding some basically precious metals and commodity exposure in general, specifically more GLD and GDX this morning. So again, definitely, I think, be taking advantage of what's transpiring in the precious metals and metal space. Crude oil, on the other hand, certainly looks a little bit different, and we are not long of USO. We're long of other commodities and other energy-related entities. And in fact, Keith actually was a seller of some of his GSG, and one of the bigger components of GSG is oil itself. So I think there's a bit of a new development here. It's been consolidating. If you look at kind of the price of crude oil for the last 10, 15 days, really 15 days, so kind of on a trade duration. But you're getting kind of back to back here, especially if we close down here sub 77. You're going to get back to back kind of fresh lows on a shorter time duration. And the top end of the risk range, which is at the moment just north of 80 at 80.19, that is not indicating kind of new 1 or 3 month highs. So it is still indicating a new kind of 15-day high. But you really want to kind of see that get captured on a bit more of a longer duration in a perfect world where that's like best signal strength. So crude oil kind of not necessarily breaking down, still bullish trend, but on a sort of shorter term duration, and certainly from a signal strength standpoint, it's losing some signal strength. Now, could it rebound? Absolutely. But from a risk management standpoint, I'd much rather kind of see it recapture and actually pay up, as I kind of mentioned last week on different components. But for oil, I'd rather kind of pay up and buy it at $79, $80, where it's confirming kind of basically that it's put in a longer term higher low, higher low, but and basically kind of a re-emersion or re-acceleration from a trend standpoint to the upside. But for the moment, I think as Keith has been doing in terms of adding to more of the equity side versus the commodity side within the energy complex, that makes a lot of sense. Like XLE does not looks somewhat similar, but a bit different than say crude oil. So I think just wanted to call that one out. Silver, on the other hand, kind of similar to gold, it is putting in higher lows and higher highs, and so that's picking up some really good signal strength across the board. And whether that's through SLV or SI, they both kind of look similar. And then, certainly within the silver equities or miners, et cetera, you can really be kind of spreading your wings there across a lot of precious metals. I know last week we talked about rare earths. Those have sort of pulled back here, but have not at the moment. It's not kind of a breakdown where I'm out. I think I shared last week that I was a buyer of some, and I'm still holding that position. And I think it's going to be interesting. It's on the cusp, though. It's on the cusp of kind of breaking down on a 15-day basis, but we shall see. So a little bit more time and space here will be the indicator. And if it doesn't, then it doesn't, and I'm out, and not a big deal. But at the same time, I think the metal space in general is certainly looks a little bit differently than, say, the energy side of the equation. Natty gas, on the other hand, just continues to put new highs in. So that's a whole new ball game, and certainly a fresh development for natural gas at this point in time. I think the other component that's certainly of interest on the metal side would be your copper, right? It's a base metal, but copper has pulled back, had a pretty big, I think it was like down 5% yesterday. end up closing down, just north of 5%. So again, this is just sort of a natural pullback after a pretty big run up. But certainly something that you got to be paying attention to regardless, right? Anytime you got a big move like that, it's certainly something that you got to be like, oh, okay. So just kind of wait and watch as we continue to move out in time and space. So we get some consolidation around here at the, say, 480 level. That could be a really good thing, actually, because it'd be kind of almost like resetting at a much higher low than the last sort of 63 days or 3 months or so, even the last month. That'd be a good thing. Now, if we get kind of the low end of the risk range down this morning, is at 4.65, then that could be a bit of a different picture. But for this point in time, it's more of a take advantage of weakness and certainly be ready to execute if you get some consolidation down at the low end of the risk range at a higher low. So just want to call that one out as well. I think it's an important one to be paying attention to across the board. In terms of the dollar, that guy is very interesting. On a day-over-day basis, you basically kind of have you had a flat lower end of the risk range, but a relatively big lower high on the top end, down from 105.41 to 105.28. And that, again, it's not saying that you get out of your dollar position, but it is certainly indicating that you don't have quite as much to the upside, and that's a big thing from a signal strength standpoint, right? And so I think there's something to just be paying attention to. Also, the euro US dollar moved to neutral trend today, and we've got the pound versus the US dollar at euro USD. I don't think that wasn't neutral today, but it's neutral as of, I believe, this week. Yes, so just kind of paying attention to that as well. And obviously the pound versus the dollar is bullish trend. So not everything in FX space is kind of lining up, but perhaps we just get a little bit of higher for longer from a central bank global kind of rate standpoint, and that's translating into a bit more sort of stability and or kind of a tighter risk range within currencies as well, which would make a lot of sense. So, and you also get that if you go back to like FX vol, it's down sub 7 at 6.79. So again, you're getting kind of like there's just this volatility complex across the board. A lot of suppressed volatility out there. Even oil vol, is down at kind of basically 28. At least that's where it traded yesterday, or closed yesterday at 27.71. It's up slightly today, up just north of 28. But again, oil vol is not saying, oh wow, crude oil is like in for a really bad time. It's just saying that you just got however, on like a 1 month basis, it is trying to break out to the upside, but it's certainly not holding. It's not making any new kind of 1 month highs there on the OVX side of the equation either. NVIDIA, if we kind of just bounce around to US equities, if you look at sort of the MBAD indicator, I have the pleasure of seeing that from Tier 1 Alpha. It is loading up. So sorry, I just hit refresh, make sure I had the right data. NVIDIA is obviously has a huge it's certainly propping up the market. Let's put it that way. I think the positive impact is on the SPX is over 40%, 40.70. Given its north of 10% daily return move, it's a big outsized impact on the market at the moment. And I think the interesting thing is that you've got kind of Apple and Berkshire Hathaway, J&J, Tesla. Those are sort of some of the leaders to the downside in terms of their negative impact. But realistically, you got NVIDIA, Lilly, Microsoft, Meta. All of those are positively impacting the market at the moment. And you've got sort of a relative weakness in breadth. Basically from here, you've got 111 stocks that are advancing, 311 that are declining. So that's about 70, almost 78% of their overall S&P 500 are actually declining in price, with NVIDIA obviously propping things up. So just keep an eye on that. I think this is one thing where, depending on your time horizon, if NVIDIA gives anything back kind of tomorrow, stuff like that, it could have the opposite effect of today, which would be sort of a negative impact. So again, just kind of keep an eye on it. Realistically, though, if you got anything longer than a sort of 1 day time horizon, which I think most people do, you'd really be taking advantage of this current setup. I think, basically in that mentality of buy the darn dip across most of the things that we like, especially with, as Richie highlighted this morning in the early look, which was a really great early look. So please, if you haven't read that, please go do so. But we've got back-to-back quad twos in May and June. And again, he astutely pointed out, somebody asked, like, well, when does it end in June? Well, it's just more of like a situation where I liked his analogy where it was, once you get to the end of June, it's more about kind of like just having your wits about you as you kind of enter maybe a little bit of a rougher neighborhood from the quad two. Just any story is a good story type mentality, and that you're going to see in the market. So why don't we kind of open up the floor? If anybody's got any questions, happy to take them. So I'm going to just take a little sip of water here. And then the other thing, obviously, it's been a big topic, certainly out of Mucker, and we've been talking about it a lot as well in regards to the Eurozone, right? And just getting access and adding it to your overall portfolio. It was one of the kind of key trends that I highlighted at Hedgeye Live a few weeks ago. So again, I can't believe that was almost like 3 weeks ago now, but basically, those trends, and I think they're continuing to play out, is getting access or getting exposure, inside the portfolio to Europe, generally speaking, to commodities and inflationary aspects, generally speaking, but paying attention to, what crude oil does, because it could have a bit of a drag on, say, the overall CRB index and or GSG. And then, what is also happening in EM and other countries, basically the whole global quad one, quad two dynamic. And, China's picked up and is reporting really solid economic numbers. But generally speaking, at the conference, we were talking about EM ex China. And, again, Keith and Richie did a great job this morning reiterating just how strong the GDP growth is in India. And then on a rate of change basis, how positive the rate of change from a GDP acceleration standpoint is for, a country like Germany. So again, just, that really just reiterates the point of wanting to and really needing to have some European exposure and EM exposure in order if you do have a benchmark or are competing against others in this marketplace from a portfolio analysis standpoint and or portfolio construction standpoint. That's how you're going to kind of beat your likely. That's certainly the way that we would be positioning our portfolios and in anticipation to try to beat our competition. All right. So if anybody's got any questions, again, feel free to jump up and speak. I know it's about 12:20, so lunchtime here on the East Coast. Perfect. And if not, then we'll just keep on rolling. One of the questions I got yesterday on Twitter, which really was kind of a little harder not harder to explain, but Keith did sort of quasi addressed it on the macro show this morning, but the question revolved around kind of like, the correlation or sort of the move index and its relationship with like TLT. And when I shared my tweet last night about kind of the move breaking down and being at its lowest level since 2019, it really isn't, my indication wasn't really kind of like hey, like have this, the move down means like bonds are going up. It's more about the higher for longer comment and the fact that your risk range or your probable range, because of lower volatility, regardless of whether capital flows to it at lower vol, which is very possible, and it's potentially likely, but realistically, a lower volatility measure just means a tighter risk range, and that's kind of, I think, the main point that Keith's been trying to get across the last week or so is this whole higher for longer standpoint, and the fact that maybe there's one interest rate cut in Europe now, maybe there's one here in the US, but realistically, the low end of the risk range on the 10-year is 4.55, which really means that on any daily basis at the moment, you really can't get under 4.5. And on the top end of the risk range, the low end of the risk range is 4.35 and the top end is 4.55. So, it really can't get, sub 4.25 at the moment, really a worst case scenario. And on the 2-year, it's basically 4.75 is the low end of the risk range. So 4.75 with the top end just inside of 5 at 4.96. So that's kind of, again, a bit of a shift in regards to, could we see 5% again? Possibly. But realistically, it seems like we're going to be kind of, with lower volatility from the MOVE index, you're really just going to get kind of a tighter band and a tighter window in terms of where rates will trade. Can that be good for overall duration? Yeah, it can actually. So, could you see that flow through to things like a TLT or SHY? For sure, because anytime you get lower volatility in something, it does attract capital, and more capital is able to basically be able to flow towards it because it has lower volatility. So just kind of, again, like from a correlation standpoint or a relationship standpoint, the call out yesterday was less about kind of like what it means for kind of bond exposure or rates exposure, and more so about kind of just the volatility complex and what we're seeing at the moment, and the fact that it's really echoing across all complexes in regards, or all asset classes, excuse me, from whether it be from rates, fixed income, to high yield, to US equities, to commodities, to FX vol, et cetera, et cetera. So it's really, that was more what I was trying to get across with that tweet. But at the same time, we've mentioned it here multiple times on the Notebook Review, and certainly my good friend David Salem within Capital Allocation, he, that within that product set, the bond complex, international bonds, whether it be EMB or BNDX, or, if you want some inflation protection, WIP, US that's international, US would be TIP, TIP. Those are all areas where we think have kind of positive longer term return prospects, and certainly with a breakdown and/or a kind of lower level of volatility within, move really depicts more like US vol, or US fixed income. But regardless, those are areas from a fixed income standpoint where we have had and we continue to kind of recommend or have a positive long-term return prospect within those areas. All right. So I guess nobody's got any questions, which is totally cool. But again, I welcome any feedback, any commentary, any questions, anything that you guys are seeing as well. I think it's really important to do that. This is sort of, again, Notebook Review is much more of it's supposed to be a back and forth with Hedgeye Nation, talking through things, talking about signals. I've certainly conveyed the ones that are top of mind for me at the moment. XLK, within US equities or sectors, one thing I have not mentioned is certainly technology. XLK looks like an absolute rock star these days. Just continues to put in higher highs and higher lows. There's a big higher low and a big higher high this morning. The lower end of the risk range now is at 207. The top end is up at 221. So that's indicating again new 1 month, 3 month highs and a big time higher low at the moment. So that's a really good setup. And something like an XLB was the RTA button was hit yesterday on that. But interestingly enough, you did get a bit of a lower high this morning. Could it be just a little bit of a kind of a nothing burger? Absolutely. You're sitting pretty much right at the low end of the risk range at the moment. And so we'd be kind of taking advantage of that, given the fact of given its overall signal strength, but just wanted to call out that lower high inside of basic materials this morning as well. All right, Philip's joining me. Philip, welcome, my friend.
Hey, how you doing, Robert?
Good, buddy. If you didn't jump up, this is probably it was gonna be basically a 30-minute notebook review.
I figured I did actually have a question today.
All right, let's do it.
I had I texted you. I've got construction, so I'm just going to ask you quick and then probably jump off so avoid any hammering and drilling that's going on here. But this morning, Keith made a comment on the macro show about he was talking about silver. He was talking about like buying and almost like a relative buying decision. Should you buy when something has corrected a little or a lot?
Uh-huh.
And I was a little bit confused on the point because I thought this was like in the context of signal strength.
Uh-huh.
And to me, something that corrects less exhibits stronger signal strength behavior than something that corrects more. So he was saying, I think he was saying that he was going to wait on silver because it wasn't quite, it had corrected more, but it still wasn't quite at the low end of the risk range. So sometimes I get confused where I understand the low end of the risk range concept, but you see things that have very, very strong signal strength that correct like almost nothing, right? And then they just keep going from there. So I was curious, what were your thoughts on that? On buying something, middle or still towards the high end of the risk range if it looks like it's the stronger signal?
Yeah, it's a great question, and I think unfortunately it really depends, right? So it kind of depends, and that's really the core reason why we have a 3-factor model in terms of price, volume, volatility, because it really depends on not just what price is doing, but what volume and volatility is also doing. So something that's got a strong signal and has maybe moved pretty significantly, like SLV here, right? And so you got a pretty large price move, and so on a pullback like this, like what's the other factor is like what's the volume and volatility doing? Are these back-to-back down days on kind of relatively lighter volume, and is volatility kind of basically staying relatively benign? Or are things or other things kind of occurring, right? So I think that's really, unfortunately, it really does just kind of like depend in terms of what. Let me just pull up. Sorry,
that's a good point. Like look up IAK today. The defense stocks. They're all within industrials, right? So this is part of the XLI trade, right? If you include manufacturing and defense and throw out like airlines, that's kind of where the XLI growth is coming from. But look how strong IAK has been. And you get, even over the course of the last week, you had a correction in price. I'm not talking about the risk range of it, in price from like 118 to here it's at 115.4. And I see the risk range to me is kind of consolidating. It's kind of doing like one of those consolidation, lower high, higher low things. And I look at the volume today, and the volume is trending like way below average volume.
This space was downloaded via spacesdown.com. Visit to download your spaces today.
Down price day, right?
Yeah,
so
exactly.
this is like one of those examples where you say, look how strong this thing has been over months, and it's not at the, I don't have it at the low end of the risk range, but it looks like a buy to me.
Yeah, so I mean, the loan to the risk range, luckily we get IAK every morning, right? So that's at 114.71. And I think this is so that's a good example, right? Where volumes, I've got volume at basically 28% of today's volume is about 28% of the average 5-day volume. And that's the main measure that I track in terms of like the duration. But again, you can go out on different durations, 1 month, 3 months, et cetera, and review that. So I think it's a really good point. And I think the other component too here is that, again, from a very shorter term duration, from like a 10-day standpoint, or even 15-day, but certainly 10-day, this pullback isn't putting in a fresh kind of like very shorter term low. Like that low was on May 15th down at 115. It's about 1.6 is where it closed. So we're kind of holding that as well. So yeah, I mean, this is one where if you've been running with IAK and it's somewhere between a min and mid-sized position, I'd be I think it's a good call out, Philip, where you can add some back, or you kind of be a little bit more patient, and you say, okay, is this just sort of like a one and done situation? And again, I know we like to buy on green, but sorry, on red. But again, it's one of these things where it's like, okay, this is perhaps the first day down. Do you just give it a little bit more time and space? Does it kind of rebound tomorrow, or does it sort of, kind of pick up, maybe it has a little bit more momentum to the downside on a weak volume as well, and then you kind of step in. So I think that's a big thing, but certainly from a price volume volatility standpoint, IAK looks quite good. Silver, for some reason, my volume indicator wasn't being pulled up, but yeah. So SLV, if you just look at that ETF, that's the one that we get the risk range on. It's trading at about 69%. Today's volume on this down move is 69% of the average 5-day. And then yesterday, though, it was a bit of a volume acceleration. So that down move did have some gusto to it. It was 120% of average volume. So that was something that where I didn't really want to step in front of yesterday's move, but certainly today, where it's down below in the risk range, and if you look at the Portfolio Solutions product, the daily re-rank, you'll see that Keith actually added. He bought some silver. He actually added a new silver exposure altogether to kind of take advantage of this move lower. So although he did say that on the macro show, certainly when he got to his desk and reran the numbers and kind of looked at the 3-factor model, he came up with a bit of a different answer. So.
Yeah, that's a good call out.
Yeah.
I saw also platinum down 1% today. It was on higher volume yesterday, kind of the same pattern. And there's a ETF I look at, GLTR, Golf Lima Tango Rio.
Mm-hmm.
That's a precious metals, and so you see that kind of same pattern, right?
Yep. No, exactly. Yeah, exactly. I think if you pull up just something like a VGK in terms of like Europe, right? It's down today, or sorry, it's up slightly today, but really like yesterday's down volume was on volume, but today's slight up move. But you also got it's kind of reacted with the US, right? So this move is kind of pulled back. It's still up on the day, but today's volume is only about 74%. So to me, again, if you don't own this already, it'd be you want to kind of see maybe one more day of positive price action, and ideally on a little bit of volume, and then you'd be kind of like stepping into it, even though it's closer to the top end of the risk range. But again, that's like another one where it doesn't often give you a lot of corrections, and even if you just use something like the EWG, like Germany, today's price action is on 140% of volume. So that's probably an even better example in terms of, hey, that's at one of the top 4 of Keith's like signal strengths in terms of exposures in Europe. And you're getting kind of a similar move in terms of like plus 35 basis points as VGK, but you're getting it on volume. So that's a good thing.
Yeah, because most of the individual countries are not really selling off today. So
no,
at least on my screen, like there wasn't really that much to buy, but I did buy yesterday when they were down. Yesterday or the day before, I forget. They were down a little bit more. I saw outside of Europe, Canada. Canada's been correcting for 3 or 4 days. I think it's probably. I mean, I could see the correlation with crude. But Canada's holding in there. It's not really breaking down. And at least on the EWC, the volume doesn't seem to be that excessive. So not really selling off too much.
No.
Not a lot of volume either behind this the sell-off in the last few days. And
agreed.
Showing some strength, still above trade.
Yeah, no, exactly. And I think it's let me see. It's positive on the 1 month and 3 month base, like just the TSX, like S&P TSX. It's positive on a 1 month just from a price action standpoint. It's actually the third best North American performer behind both the Nasdaq and the S&P 500 on a 3-month basis. So it's definitely been holding in there. But there's I'd say from an overall standpoint, probably, there's definitely been better performers out there, whether it be the UK, Germany, Netherlands, Amsterdam, right? India, even Japan lately, and Taiwan as well. So it's a good call out. But
even if you wanted to go Latin America, you can look at like Peru.
For
Peru's
sure.
down the last couple of days. I think I would guess. I mean, we don't really speculate and figure out the why, but if you look at copper, hard copper correction, that could easily explain that.
Exactly.
That's also why EPU has been going up so much over the last several
6
weeks, months.
Yeah. Yes, yeah. Yeah, it's been a good performer for sure.
I keep looking at Mexico and Brazil, try to see if these things are going to turn around. I know they're in kind of some quad threes, and I'm not buying, but I'm watching. And Mexico has an election coming up in 2 weeks.
Yeah, that's EWW, right? Is Mexico? Yeah.
Yeah.
So they have an election.
I mean, it's not.
I did not know that.
Yep.
All right.
Yeah. I mean, Mexico's not looking hot. Yeah. It's not on a relative strength basis, right? That's what we talk about and why.
Yep.
Europe is so much more attractive, or something like a Peru versus a Mexico. Or
correct. Absolutely. Yeah. No, I think you're spot on. Listen, in a global quad 1, quad 2 environment, pretty much a lot of things are going to go up. And I see my buddy Chris Moyer, who actually just requested to speak. He's often said, and I'm going to repeat what he said, but basically, in a quad 2, quad 1 environment, almost everything goes up, right? So in a global quad 1, quad 2 environment, a lot of these countries are gonna look good, but then it's a matter of trying to find relative signal strength. To your point, Philip, right? So on the U.S., right, when you got U.S. quad 1 and quad 2s, even utilities move higher, but then it's like, okay, so you're not losing money in utilities. You're up, again, I'm making up numbers, but you're up 12% utilities, but XOK is up 40%. So it's like, what's the relative, what's the relative winner? And again, not everybody can own technology, and there's absolutely many different ways of portfolio construction, risk management, drawdown risk, turnover constraints, all these things that we certainly try to address within the capital allocation product with David Salem. But at the same time, it's if you can, and you can have your druthers, then on a relative basis, you're going to want to try to find the things that are continuing to be in uptrends, continuing to put in higher highs and higher lows, and continuing to sort of basically give you the best signal strengths.
Yeah, I mean, it's like treating your units of capital like a scarce resource, right? And being thoughtful about the opportunity cost of being in one security versus another.
100%. I think that's a really, really, yes, 100%, right? And although they're all just pieces of inventory, some inventory is better than others, right? And I think actually Keith has used this analogy on a notebook review a long time ago, but he was like, if something's on the shelf and even though it's a good product, if it's not selling, or if it's not selling as quickly, or the margin isn't as good as the thing that's next to it, then you really want to have more of the thing that's next to it because it's selling faster and the margins are better, right? So again, not everything is created equal, as you said, and they are all just pieces of inventory, which is definitely the right mentality to have. Mr. Boyer, welcome. You're on mute. Oh, there you go.
Hey, buddy.
How you doing, bud?
Yeah, good. I just wanted to make a comment to Phil as well. Like, I don't have any idea of how Keith calculates his stuff. I just know how I calculate mine. And something that very rarely gets talked about in this is when the signal strength changes, something that's very easy to look at is, did it change today? Let's just say you're using a 30-day window. did the signal strength change because of the price change last night, i.e. the closing price, or did it change because the price that was in day 30 is now becoming day 31 and is no longer in your look back? Because the signal strength can change because of either, right? So just because something has a move today and signal strength changes, it doesn't necessarily mean it's because of today's price.
It's a good point.
So that's something that you have to take into consideration of whether it's moving, if you have a basket of 20 things and the signal strength is changing, like which one is it? Is it because of today's price or last night's price? Or is it because day 30 now disappears because it becomes day 31 and you're no longer looking at it?
Yep.
It's interesting. You said that. I'm looking at the chart of Newmont Mining NEM that was just an email was just sent out on the long. And if you look at April 25th was a huge price change day, a huge volume day, and that's like a month out, right? So that's like the kind of day that will really move, really affect something, and then it's going to be dropping off soon.
So that day disappearing is going to affect, if you're using some kind of 1 month average for volume, if you're using it as a calculation in volatility. So depending on how you use it, if you're using options, if you're using implied volatility, that's maybe a bit different. But if you're using some other method of calculating your realized vol, then, if it was a big day, that means it's got a big difference between the high and the low of the day, which will go into, depending on how you calculate it, there's lots of different ways, but that'll go into how the 30-day realized vol is calculated. So that's going to shift as well. It doesn't necessarily just mean because of what the price did yesterday.
Yeah.
And that goes all the way through, right? So if you're using some kind of combination, you then have to look at, if you're using 15-day or 30-day or 60-day or some combination of all of them, you have to look backwards and go say, okay, well, what was happening 60 days ago? Because that's going to shift how everything's going to move going forward, just as much as today's price, right?
Yep.
You've got me going back through some of my homework this morning and checking on some of this on some of these moves a month ago, making sure I need to put this all into this, much more of this daily process on paper, and I think eventually it'll help me have a consistent process every time I'm looking at a security. Right, all the different things that you're looking at. Sometimes you'll forget volume, or you forget the look back, or where trade is, right? Something like that.
Yeah, I mean, if you use TradingView, I definitely think Robert's showed this before, but from one of our old videos together, one of the guys in the arena, well, used to be the arena, made an indicator called DCC. Donchian channel or something, but that will show you the price thing, so you can just have a visual representation. I used it as like a box in time, and you can see how that box shifts, and it will show you what the old price was. So if you want to use, 30-day and 60-day, you can do that, and it will show you really quickly. You can go backwards and go, okay, well, this is how, even if you want to go, how is the old price is going to shift over the next week, and you can just quickly go and have a look and see it. Just as like a visual guide. It's really important. That's one thing for me. It's really important to see what the old prices are doing, just as much as what today's price is doing. Even though today's price is the newest piece of data, if you like, the old ones will shift just as well.
Yeah, exactly. Like Newmont's a good example here, where like on the 15-day window basis, the pricing May 3rd, that low, which was 40.66, that's going to disappear tomorrow. And then I think 41.39, 44, 54. Yeah, so like we're going to be Yeah, so if it closes here for Newmont, we'll just hold like basically the 15-day low as of tomorrow, because that'll be 41.39. But that'll only last for like a day. So we're right at. Again, I haven't read the real-time alert from Keith, but I suspect he probably mentioned something where it's like, again, he hits an RTA typically when it's right at the low end of the risk range. So this sort of definitely fits the bill in terms of, low end of the risk range and taking into consideration what prices are falling out of the look back window. Again, I don't know how Keith does his, but just from a purely from like a look back standpoint, this could be basically very close to kind of like the low end of the risk range. And if it holds, then that's exactly what you want, and that's exactly where you want to enter. But at the same time, if it starts to break down further, then you gotta know come tomorrow, then that today's price action is not only just a new 10-day low, it could also be a new 15-day low.
Yeah, so actually Newmont's a pretty good example because I have 21-day and 63-day that was just set on here, so I'm looking at it.
Yeah.
So February the 28th will be a low. I don't know if you can hear my kids singing in the background. So February 28th will be a low. So moving through from there, and if you use a 3-month measure, it means that every day now for the next 6 weeks, the low end of that price is just going to constantly shift up because it had an up move from that February 28th low. And the way I've thought about it, again, this is purely for me, it's not a representation of what Keith does. But what that then does is it compresses all of the prices. So if you use that DCC indicator,
the box is going to shrink.
I had basically a middle of the box. So I had a kind of middle, and that's what it was. So when we made that video, I had no idea that it was already a thing. So it's called these Donchian channels. So I thought that I had to come up with something, but I hadn't. That's everything else. Right? No, it already exists, right?
It's a Donchian channel. I'll share whatever. There's an indicator. I literally have it up all the time on my trading view. So yeah, Chris, I still use it daily.
So what it will do is, let's just say Newmont stays in and around where it is, in and around, I don't know, between 41 and 45. The high end of that box isn't going to really shift, but the low end of the box is going to keep shifting up every day we move forward. And what that will do is then, obviously, if you divide something by 2, and one end of it, the bottom end, is getting higher, it means that middle part is going to also get higher. So the way I used it in the past was that what it means, it's not predictive of anything. It's just simply saying that as you move forward in time, the distribution is going to shift and going to get squished and get smaller. And all it will mean is either it'll cause it to move in some way, or how I ended up using it was that middle line of that channel. If nothing else happens, it's going to get shifted and go closer to price, which means it has a greater chance of breaking.
Mm-hmm. They're basically moving from the top end of the box to the lower end of the box.
Yeah, because those prices, those old prices from the end of February going through March and April, will keep shifting up. So it just means it's putting it into a place where it has a greater chance of breaking.
Yeah, exactly.
But that's 5 or 6 weeks of prices. So
correct.
It can do lots of different stuff between now and then.
Yeah. Yeah, the other thing too, again, just I don't know, we're on this DCC kick, but the other thing with Newmont is because the box is so wide, especially on a 3-month duration. I mean, the low end of the box is, as Chris said, is down at 30, and the top end is up at 44.5. So you got a pretty wide box, which means you have kind of a relatively wider measure of volatility on a longer duration now. And similarly, Philip, you mentioned that basically on a 1-month basis, you've got that big earnings jump, both from a volume and price standpoint. And so so that kind of volatility, the boxes are still pretty wide. kind of both on the longer duration and the shorter duration, which is interesting. Newmont's actually a really good example right now. Yeah, it's a good job calling that one out, Gold. Philip. I think he's on mute. Nelson jumped up too.
Hey, Robert. Hey, it was great seeing you at the Hedgeye Live.
Yeah, buddy.
To build on Chris's point, the DCC is not exactly trend. I use my own signal to my own formula to create trend.
Yeah, we weren't. Hopefully, it wasn't coming across as we're not talking about that as trend, right? We're just
no,
like just being the upper end of the box or the lower end of the box.
But if the volatility isn't crazy, it's actually fairly close sometimes, right?
Mm-hmm.
So if you're computing your own trades and trends, where you have it from Keith, his signals, and it breaks the trade, that 3 months DCC is probably your target, right? If you want to just kind of like do a quick and dirty version of where you think it might be dropping down to and keep an eye out. So that's how I use it for in that sense. It's been fairly helpful to kind of know, there's still some downside and it's probably going to be somewhere around this area. So it helps me from jumping back in to something that is positive trading trend, right? Or breaks trade and is still positive trend from jumping back in too early. So that's my 2 cents.
Nice. Yeah. For me, again, it's less about kind of where the middle box is. Again, like it's just like, Chris has used it one way. I really use it more so just from a pure visualization, a quick and dirty way of reviewing where price, basically where the price is from a look back window standpoint, both the top, like the highest price and lowest price, right? So like where are the boxes, and then on different time horizons, and then to Chris's point, really what prices, like where could we be in like a week or 2 weeks time or what have you, right? In terms of like what prices leaving the look back window, and therefore what could that mean from basically the low and the lows and the highs that have been historically basically put in place, right? So that's for me personally kind of how I use it. It's more of like a very simple tool to help kind of visualize what has transpired, and then what depending on what price does, like where could you get kind of kind of like a shrinking box, right? Like just purely because regardless of what price does, just because of things that are falling out of look back window. And again, Newmont's a pretty good example where on the 3 month duration, just from time and space, you're going to get kind of that low end of the look back is going to come higher, just because, as I said, or just as Chris said, just because of time and space.
Right. And even gold, if you look at gold is about 3 days from, to Chris's point, where you start seeing that low end of the look back window. That's going to start coming back up, and then it levels off in about 2 weeks for a few days, and then it's going to start coming back up. So what we're basically looking at is the compression of the gold price over the next 3 months, right? Or over the next few weeks, excuse me. And if gold retains trend, and we've got a compression of the range, then gold is likely going to be moving much higher. So that's how I'm interpreting it, and that's how I use the DCCs for it too. So exactly like you guys are doing it and trying to see like where it stands. So
nice, awesome.
Thanks, buddy.
Yeah, man. Enjoy the afternoon. Anything else on your
downpours we're getting? It's
oh yeah. Anything else? Again, just from anything else popping up? I mean, obviously, you just called out gold.
Yeah, I'm actually at work.
Oh, no worries, man. Yeah.
I've got it sitting there on the sidelines from trying to do it's just everything that's inflation related is looking to be, to borrow Keith's phrase, a similar set, right? Things are compressing and they seem to be poised to be jumping higher.
Awesome. Well, hopefully the lunchtime notebook review is it's good to have you on, and always good to chat with you. So thanks for making the time while at work, and for many of those that are doing the same, appreciate it. Appreciate you tuning in. We may call it a day. I think last week I did mention that there's going to be a little bit of an announcement, so I will finish off with that. But I have the pleasure of joining David Salem on the capital allocation team here. So this is my first sort of full week with David, which has been awesome. So those that are subscribers, you would have noticed, we released a fresh dashboard yesterday morning. So kind of look for me to be spending more time with David on the capital allocation team, and obviously producing more kind of content on that side of the equation. So just kind of wanted to put that out there, and it's very exciting. And David, so just pretty honored to be on his team, and it's going to be a lot of fun to help build and grow and continue to execute and learn. So it's going to be a lot of fun. But so we'll wrap up notebook review here this week. So thank you everybody for tuning in. We appreciate it. And as always, well, next week's a short week, so probably do it on Wednesday, but I'll keep you guys posted. Have a good one.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.